US and China have reached phase one of the trade negotiations, which perhaps signals the beginning of the end of the trade war, which has had an impact on the global markets for the last 2 years. Let's do a three-point analysis of the key takeaways and also what's next. 1. Key takeaways from phase one of the US-China trade deal. Well, the deal brings in several commitments from China's side for the higher trade as well as a transparent dealing on the US concerns such as intellectual rights as well as technology transfer, etc. Now, while there are apprehensions on the enforceability of the commitments, as of now, it does put the worst of the US-China trade war behind us. Major takeaway from phase one deal includes a commitment from China to import additional $200 billion worth US goods and services over the next 2 years compared to what it used to import in 2017. Now, this would also lead to more than 50% increase in US exports of trade and services to China on an annual basis. China's increased imports and services are expected to continue, should contribute significantly to the rebalancing of the US-China trade relationship. Now, as per Reuters, $200 billion worth of additional exports to China would comprise $80 billion worth of manufactured goods, $50 billion of energy supplies, and $30 billion of agricultural products, and $35 billion of services. Now, this can significantly reduce the overall trade deficit of US versus the rest of the world from $628 billion in 2018. 2. What are the other observations? Well, there is some progress on the contentious issues of technology transfer, intellectual property rights, etc. Now, China has agreed to end its long-standing practice of forcing foreign companies to transfer their technology to Chinese companies, and as a condition for obtaining market access to China. To sweeten the deal, USA has also removed China designation as the currency manipulator in the semi-annual currency report. US Treasury mentions that China has committed itself to refrain from competitive devaluation as part of the phase one deal. Now, China's commitment also shows sharp jump in the imports from USA to China in the times to come. It remains a big question as to how China's implementation of the same may require a substantial rejig in China's trade relations with other major partners as well. Now, from the USA side, there is no substantial rollback in trade tariffs. As part of the precondition to the deal, US has agreed to shelve the plans of tariffs on another $160 billion of Chinese goods, which is scheduled to take effect from 15th of December backwards in 2019. Additionally, it has reduced by half the 15% tariff rate it imposed on $120 billion of goods. Now, that was effective from 1st of September. Now, this said, this also includes 25% of the tariff on $250 billion of Chinese goods and 7.5% of tariff on $120 billion worth of goods. Now, average tariffs on both sides are in the vicinity of 20%, marked change from what was prevailing in the pre-June 2018 era. 3. What's next? So, most of the additional tariffs appears to be a new normal for both the countries in the near term now. We also believe that the US-China trade agreement, along with the certainty of Brexit post-UK elections, also improves the global trade outlook for 2020. Now, for Indian equities in particular, export-oriented sectors having high exposure to US demand should definitely benefit. Sectors such as metals, chemicals, pharma, they can capitalize on the import substitution opportunity in the USA. And hence, investors can really position their positions accordingly. News reports suggest that any reduction in tariff may be considered in the phase two of trade negotiations, which may conclude only after US president elections in November 2020.